Imagine the deepest fear of every global economy, not a mere recession, but a total systemic shutdown where the financial circuits burn out. Today we delve into Wall Street's darkest secret, uncovering precisely how the 2008 financial crisis explained itself through a catastrophic chain reaction of leverage and misjudgment. For a fleeting moment, the very heartbeat of global commerce flatlined, revealing a vulnerability so profound it threatened to unravel the entire edifice of modern capitalism. This wasn't just a downturn. It was a near-death experience for the financial system itself. What was this unseen mechanism, this ultimate trigger that turned a housing slump into a global financial apocalypse? A signal so clear in hindsight, yet tragically ignored in the moment. We will strip away the public relations narratives and the political blame games to isolate the cold, hard data points that marked the system's terminal decline. Our objective is not to assign moral fault, but to conduct a forensic autopsy on capital structures and market interdependencies. Let us establish the quantitative baseline of this financial malignancy: $7 trillion in value. This valuation was fueled by a credit expansion predicated on increasingly lax lending standards, transforming traditional mortgage assets into highly sought-after securities. The global notional value of over-the-counter derivatives, including credit default swaps, soared to an astonishing $683 trillion by 2007. To put this into perspective, the entire global GDP at the time was roughly $54 trillion. Meaning derivatives markets dwarfed the real economy by more than 12 times. Major investment banks operated with leverage ratios exceeding 30 to 1, meaning for every dollar of their own capital, they were borrowing $30 to invest. This created an extraordinary amplification mechanism for both profits and losses, laying the groundwork for unprecedented systemic risk. The raw variables demonstrate a market engineered for fragility, not resilience. Mortgage-backed securities, or MBS, initially seen as low risk due to diversification, began to deteriorate in value as housing defaults accelerated. Subprime mortgage delinquency rates, which averaged around 6% in 2004, surged to over 20% by early 2008. The AAA ratings assigned to many of these structured products by agencies like Moody's and S&P were fundamentally flawed, based on historical data that failed to account for a synchronous national housing downturn. These ratings were critical because they allowed institutional investors, often bound by mandates to hold only high-grade assets, to purchase highly risky instruments. The underlying collateral in many CDOs, or collateralized debt obligations, was a complex layering of these increasingly toxic subprime mortgages. When the housing market turned, the bottom layers of these CDOs collapsed, triggering a cascade of downgrades and reevaluations. This brings us to the fatal mechanism: the interconnected web of credit default swaps, CDS. A CDS is essentially an insurance contract against bond default, but it evolved far beyond its original purpose. Speculators could purchase CDS on bonds they did not even own, creating a vast shadow market of synthetic risk. When MBS values plummeted, the institutions that had sold CDS protection on these assets, such as AIG, faced staggering payout demands. AIG alone had written over $400 billion in CDS protection on assets primarily held by European banks. This meant AIG faced potential losses that far exceeded its available capital, triggering fears of its imminent collapse. The interdependence was profound. A failure at AIG would have created a domino effect across the global financial system, as countless institutions held AIG as a counterparty. This shadow banking system operated largely unregulated and with minimal transparency, making it impossible for market participants to accurately assess their counterparty risk. The second critical mechanism was the process of mark-to-market accounting, which required financial institutions to value their assets at current market prices. As the illiquid market for MBS and CDOs dried up, finding a reliable market price became impossible. Banks were forced to estimate values, often leading to massive write-downs that eroded their capital bases even further. This created a vicious cycle. Falling asset prices led to capital shortfalls, forcing banks to sell more assets, further depressing prices. This liquidity spiral intensified the crisis, transforming solvency issues into immediate cash flow emergencies. The boardroom turning point was not a single decision by one entity, but a series of interconnected policy failures and strategic miscalculations that built systemic fragility over decades. The repeal of the Glass-Steagall Act in 1999 allowed commercial banks, which hold customer deposits, to engage in the riskier activities of investment banking. This fundamentally blurred the lines between conservative lending and speculative trading, intertwining their fates. Prior to repeal, Glass-Steagall had created a firewall, preventing deposit-taking institutions from collapsing due to excessive speculation. Its removal enabled the creation of financial conglomerates like Citigroup, which combined commercial and investment banking operations under one roof. This increased the scale of potential contagion when the market eventually turned. Another critical misstep was the refusal to regulate the burgeoning derivatives market. In 2000, the Commodity Futures Modernization Act explicitly exempted over-the-counter derivatives from oversight by the Commodity Futures Trading Commission. This legislative blindness allowed the credit default swap market to balloon unchecked, evolving into a colossal unregulated casino. Key financial institutions, driven by short-term profit motives and aggressive bonus structures, made strategic decisions to embrace increasingly complex and opaque financial products. They prioritized high-yield, high-risk assets to boost quarterly earnings, often overlooking the tail risks associated with these instruments. The market consensus, bolstered by faulty rating agency models, was that housing prices would never decline nationally. This flawed assumption underpinned the entire securitization chain. Investment banks actively bundled these subprime mortgages into CDOs, and then synthetic CDOs, which were CDOs based on the performance of other CDOs or even just on CDS contracts. This layering of risk created structures so complex that even the quants who built them often struggled to understand their true risk profile. Specific institutions made critical errors that accelerated the crisis. Lehman Brothers, for example, heavily invested in commercial real estate and subprime mortgage assets. Its leverage ratio stood at 31-1 in 2007. When the housing market collapsed, its toxic assets rapidly devalued, creating an insurmountable capital deficit. Treasury and the Federal Reserve not to bail out. Lehman Brothers in September 2008 was a pivotal moment, sending shockwaves through the global financial system. This decision, intended to signal moral hazard, instead triggered a panic, freezing credit markets worldwide. Within days, Merrill Lynch was forced into a sale to Bank of America, and AIG required an $85 billion federal bailout to prevent its catastrophic collapse. The boardroom turning point wasn't a single boardroom, but a collective blind spot across the industry, exacerbated by regulatory inaction and driven by a systemic pursuit of yield regardless of risk. The mathematical inevitability of highly leveraged, opaque systems collapsing under stress was systematically ignored. The post-mortem conclusion reveals that the ultimate dark secret of Wall Street, the true mechanism defining the day banks broke, was not merely the failure of individual institutions or the collapse of the housing market itself. These were symptoms. The core vulnerability was the complete breakdown of trust in the interbank lending market. The very circulatory system of global finance ceased to function. The open loop we introduced earlier, regarding the unseen mechanism and the precise signal of irrevocable fracture, can now be resolved. It was the explosion of the LIBOR-OIS spread. LIBOR, the London Interbank Offered Rate, represents the rate at which banks lend to each other. The overnight index swap, OIS rate, reflects the market's expectation for the central bank's policy rate, a proxy for a risk-free rate. The spread between LIBOR and OIS is a direct measure of perceived counterparty risk in the banking system. Under normal conditions, this spread is narrow, indicating banks trust each other's solvency. In early 2007, the LIBOR-OIS spread was around 10 basis points. By September 2008, following the Lehman collapse, it skyrocketed to over 360 basis points. This quantitative metric was the screaming siren of systemic failure. It signified that banks no longer trusted their peers, fearing that any institution they lent money to might collapse and default on repayment. This profound distrust halted the flow of credit, starving businesses and consumers of capital. It was the moment the fundamental function of banks, facilitating the movement of money, broke. Money market funds, typically considered ultra-safe, faced redemption pressures as investors pulled funds, fearing they would break the buck, meaning their net asset value would fall below $1 per share. The Reserve Primary Fund, a major money market fund, did exactly this in September 2008, freezing billions of dollars and further exacerbating the credit crunch. The dark secret was the inherent fragility built into a financial system that prioritized short-term, highly leveraged profit over fundamental stability and transparency. The mathematical inevitability of a highly interconnected, undercapitalized, and unregulated derivatives market collapsing under a housing downturn became a reality. The failure was not a moral one, but an economic one. A unit economic model built on a foundation of unstable assumptions and amplified by excessive leverage. The system lacked sufficient capital buffers and robust regulatory oversight to absorb the shock of widespread asset devaluation and counterparty risk. The crisis illustrated a critical lesson in financial engineering. Complexity does not equate to security. Instead, it often masks risk, making it harder to identify and manage. The contagion spread because institutions were so deeply intertwined through opaque financial instruments that the failure of one threatened to unravel them all. The forensic analysis reveals a marketplace where risk was not effectively priced but systematically underestimated and distributed in ways that created catastrophic systemic vulnerabilities. The crisis of 2008 was a stark reminder that the pursuit of yield without rigorous risk management leads to mathematical inevitability of collapse. The system did not just experience a downturn. Its very operational integrity was compromised, a testament to the immense power of leverage and interconnectedness when left unchecked. To understand the precursor events to such broad market shifts, or how internal vulnerabilities can accelerate a catastrophic external downturn, consider our deep dive into the collapse of long-term capital management, a crisis that nearly brought down the financial system a decade earlier and offered grim warnings that went unheeded.